Hello and welcome to Pro Trader Strategies Market Commentary for Thursday, January the 7th. My name's Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal, where I've commented on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, I'm here to teach you some different strategies that you can implement into your own portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios. Therefore, what I'm doing could be counterintuitive to what you are already doing. Having that out of the way, let's get this on. Not a whole lot of economic data here in the United States. Across the pond, we did get retail sales numbers in Europe, and they weren't so good, a lot lower than expected and even negative in some places. So the only thing that we've gotten here is natural gas storages, which was a lot bigger drawdown than what was expected. One thing I forgot to talk about yesterday was the gas storages was at a historical build. There was like over 10 million barrels of 10 million barrels of gasoline in storage. It was expected a build of 1.8, I think, but 10 million barrels build. That is historic, and that just shows you that not a lot of people traveled on Christmas. And if you don't travel at Christmas, you're probably not buying those extra presents for the extended family. So just keep that in mind with earnings season coming up. Maybe some of these retailers didn't do as well as they thought they were going to do because, you're just not buying for that niece or that nephew or that aunt or that uncle when you go to visit their house. You're not buying an extra bottle of wine to go over to somebody's house for dinner. So if travel got crimped because people weren't spending money on gas, that's telling me that there wasn't a lot of travel going on, and maybe a byproduct of that coming up could be that retailers were hurt by that. So we'll have to see how that goes. Anyway, moving on. The reason why the overall markets are down is because China had a stop on their trading again. It opened up 5% down, closed for 15 minutes, down for 7%, and then they closed for the day. Now this is all ahead of the ban on institutional investors selling any of their stock. So they've had this ban on for quite some time. That's caused an artificial buoyancy to that market, if you will, and people are starting to scramble ahead of those institutional investors being able to get out of some of their longs. So we'll have to see how that works out on Friday. Friday, we also have the big unemployment number coming out, which is the non-farm payroll. So that's going to be a really important one. Just threw in this Fibonacci level this time, just the Fibonacci retracements on this, just because I wanted to see how it lined up with the market profile. And interestingly enough, as you can see, the market profile has a tendency to line up very closely with Fibonacci levels. As you can see, this spike here, which would act as a resistance anytime you get these little bumps, that's another support resistance area. And as you can see, this little bump in the volume profile lines up with the 50% retracement. And again, down here at the 61% retracement here, that's another little volume node is what we used to call those. Those little nodes kind of line up. And as you can tell, that's the value area high, and this value area low lines up with the Fibonacci level. So just a little interesting note there. And as you can see, the NASDAQ came down and touched the 50% retracement this morning. Looked like earlier, about an hour ago, we were going to try and cover this. Overnight, we traded down, but it caused the overall markets on the day sessions to gap down. So there's a little bit of a gap there, even though this chart doesn't show it because it's 24 hours. There is a bit of a gap on the dailies there. So that will be interesting to see if the bulls can get that little gap covered. All right. So moving on to the E-mini S&P chart here, /ES. And this came down and touched the 32% retracement level on the downside. I don't use the Fibonacci's a whole lot. I probably should have had that other one from the top to the bottom, but you know, it is what it is. So we are well below the value area low in the ES, and you know, I think it could easily want to come down here and trade into this area, and the E-mini S&Ps could go down close to 1900. I don't know if I talked about this, but the gas build, did I talk about the gas build on gas storages was 10, yeah, I think I did talk about that. I wanted to make sure I did talk about that. 10 million build versus 1.8 build, it's huge. Anyway, on to this is the daily chart on a 15-minute. It's got the volume profile broken down for the E-mini S&Ps here, and just interesting to note, it shows it a little bit better. As you can tell, this is yesterday's day session low, and the market opened up overnight and sold off of that whole China debacle. We tried to retrace that and cover that gap. It just failed by a couple of ticks there, and has since started slowly, you know, coming off a little bit. So we'll have to see. Looks like the overnight session has not been printed either, so that's kind of like a double whammy on that. The bulls want to cover that gap from overnight, and the bears want to cover it on the downside. So I got to get moving along here. Got a lot of things going on. Covering some short deltas. My overall portfolio on all my short deltas are coming in line with my profit expectations. So I've been covering those, trying to roll into some new short strategies because I don't want to really get long the overall market, even though I think that the overall market has made quite a dramatic correction. We could start to see a bit of capitulation going on right now. We'll have to check the volume numbers on what the daily volumes are there, but I'm kind of rolling into some shorter duration calls from this. But the WYNN came in, and I had on the January 72.73 call spread, and originally sold that for 29 cents, bought it back for 9 cents. And then I also had on a February 75.80 call spread in there, and originally sold it for $1.21 and bought it back for 62 cents there. So covered both of those. XOP I just put on Monday, and XOP is the spider, oil and gas exploration and production. You know, it's had a dramatic sell-off in there. I don't know that this is going to really even come back anytime soon. I'll talk about something there too. But I got 50% of my max profit on it, so I decided, or very close to 50% of my max profit on that in just a couple of days, and I've got to take that off. If you watch the webinars, you know that if I can get 30% of my max profit in a given number of days, then I'm going to take that as well. It's not always just a hard line 50%. If it's given to me right away, I'm going to take it. And XOP did that for me. I had on the February 32.33 call spread. Originally sold it for 30 cents, bought it back for 17 cents. I've got to take that profit in just a couple of days and run with it. But the interesting thing with XOP, if you look at the EIA oil inventories, like I said, that was pretty huge. 10 billion versus 1.8 billion. I just, you know, that was just blown away. I'm still blown away by that, even as of yesterday. So to add some more short deltas to my overall portfolio, remember, if I'm long deltas, I'm long the overall market in my portfolio. If I'm short deltas, I'm short the overall market in my portfolio. When you're selling calls, you're selling deltas. And if you saw what I did, I took off a bunch of short deltas by getting out of my WYNN and my XOP. So I needed to add something in. You also heard me talk about, I think that this market could be at a capitulation point. Well, I don't want to be short a ton of deltas in my portfolio if I think the market's going to rebound, because I've got a lot of long deltas in there that are getting beat up. So having said that, I'm moving to a shorter duration. Plus, we're moving into earnings season, and I want to put these strategies on where the earnings are going to come into play. So in HES Corporation, ticker symbol HES, I did a short duration call. I did the January with just a few days to go. I did the January 50 calls, sold them for 15 cents. Didn't collect a lot, but it needed to add a little bit of short delta for a short period of time here, and HES seemed to work out there. The other thing that I went into was in Walmart. Walmart's been outpacing the overall market as we've been getting crushed. Walmart's been the one that's really been rallying. You can tell Walmart's just been on just a terror to the downside, just a falling brick. And people have looked at that. Well, there's probably value in Walmart because it's gotten beat up when the broader market was rallying. Now people are putting their money into Walmart, flight to quality, if you will. And Walmart's had a benefit from that. At one point, I think it was in the last couple of days, there were several times where Walmart was the only stock that was positive in the Dow. So Walmart's been rallying. So this goes into that same mantra of, if we are at a capitulation point on the bottom, people might try and take a bit of profit. Since November, we've seen this market really rally, and it's had a 10% rally since then. People might look to start covering some of that. That's the thought process that went into this trade, to get short some deltas. And I went into the Feb 1 weeklies, which has about 29 days to expiration, and sold the 67.5 calls for 43 cents. And just to add some short duration, short deltas. BBBY, ticker symbol for Bed Bath & Beyond, has earnings tonight after the close. This goes along with the idea that maybe some of these guys, Bed Bath & Beyond really relies a lot on their holiday gifts. They're very gift oriented, and they might get beat up for it, but there is skew to the call side. This is the market maker move. If you watch on the webinar for earnings, I go into detail as to how to figure out this market maker move and everything else. And what I look at, I usually go double the market maker move, which puts me right here at about the 51 calls. So I'm going to be looking at selling about the 51 calls and selling the 42.5 puts to create that strangle in there for the earnings trade. And the weekly, one day to go on the weeklies was pretty wide markets and just not really enough premium in there for me to want to play with that. So that's why I'm going to go into the Jan monthlies with 8 days to go. That's about all I got for you guys today. Check out Friday's webinar. We're going to be doing it on put spreads from the long side, so that should be a really good one. In a market sell-off like we've seen, that's going to be something that's going to be your bread and butter. You're going to get that volatility expansion and everything else that we're looking for in that trade. All right, so check that one out. And earnings season is coming up, so go to protraderstrategies.com and check out that webinar on the earnings trades. All right, that's all I got for you. If you can't take that, take it easy.